With all the volatility in the market, most analysts are urging investors to stick with blue chips, not RDO fund manager Sam Dedio.
The blue chips are safer, but the risk reward is certainly higher with microcaps. And given the fall they've had, the Russell Microcap Index is underperforming the Russell 2000 year to date by about 300 basis points. So the smallest caps have fallen the most, so that's where the opportunity is. So I think you get more bang for your buck, but you have to have the risk tolerance.
One stock in your portfolio is Network Engines. Now this is a technology company which emphasizes storage. Is storage still hot?
Storage still is hot. Video is really intensive on the networks. Takes up a lot of capacity, and as you know, we're doing a lot more video as we talk here today. This will be probably webcast and used again. And it's much more intensive on the network. So this company really is a consulting company that allows software developers to get their programs and their applications up and running in a cloud environment much more quickly. Stock trades at about $1.20 a share, and that's currently below book value, tangible book value. The company also has 35 cents a share in cash, so when you value it X the cash, it trades at about 3.5 times earnings. So it's one of the cheapest stocks I have, and it truly is a microcap company at 50 million market cap.
Another tech name in your portfolio is ISSI. Now they specialize in DRAM. Where are we in terms of DRAM? They also are big in the cloud. We haven't heard that much about the cloud lately.
Sure, performance is really all that matters in technology, price performance. And to gain price performance, a lot of companies that create hardware and software solutions, they utilize DRAM and SRAM to improve the performance. So this company is a beneficiary of that. A lot of the products that you use, or consumers use, like the Kindle, is an example of a product they were spec'd into, GPS systems in automobiles. Their company was, a few years ago, 50% levered to the consumer. Now the consumer is only 26% of their business. So it's really a diversification story. Again, another company with about $3 a share in cash on the balance sheet, trades at $8. If you back out the cash, it's like a $5 stock. And then I think they can earn $1.40 in the next 2 years annually over that time period. That's the annualized earnings power of the company. So it trades about 3.5 times earnings. So another cheap, inexpensive stock.
Outside of tech, Dedio likes Morton Steakhouse, which he says will sizzle despite worries of a double dip.
They might slow down their purchases, as we learned back in the recession that occurred in 2008, 2009. However, Morton survived. The brand stayed intact. It still performs well today as it did back then. They didn't really tarnish their service delivery or their brand. They didn't offer specials to reduce the value proposition. They kept pricing firm, and they continue to attract the high-end diner. And corporate expenses are allowing diners to go out and spend for corporate budgeting purposes, again, for entertaining. And also, consumers are slowly coming out of the woodwork to go out to eat for special occasions.